Most people spend their entire lives trying to crack the secret code to making money, mistakenly assuming that accumulating capital is the ultimate goal of the financial game. However, after 7 decades of observing the markets, I can tell you with absolute certainty that making money is the easy part. The truly complex part is retaining it under the constant pressure of chaos and entropy. I've seen brilliant minds, men with PhDs and impeccable track records, reduced to absolutely nothing by a single miscalculated decision in a moment of weakness or arrogance. The case of my friend David, who evaporated $40 million in just 6 months, is not a statistical anomaly, but a brutal reminder of human fragility. Wealth isn't protected with complex charts, but with a mindset that prioritizes survival over any potential gain, no matter how tempting the offer. The concept you must burn into your mind is antifragility, a term popularized by Nassim Taleb that describes systems that not only withstand stress, but thrive under it. A fragile system is one that shatters under volatility, like a crystal glass falling to the floor. A robust system withstands the impact but remains unchanged, like a rock. However, an anti-fragile system is like the Hydra of mythology. When you cut off one head, 2 more grow back. In the context of your wealth, this means your financial structure must be designed so that a market crash, a debt crisis, or a geopolitical shift not only leaves you unscathed, but also positions you to a competitive advantage, allowing you to absorb the assets of those who failed to prepare for the downturn. Anti-fragility is the only true defense in an inherently uncertain world. The first rule for building this fortress is the complete elimination of the risk of ruin, which sounds trivial until you realize that most investors constantly operate on the edge of the abyss. The risk of ruin is any probability, however small, of being permanently out of the game. If you have a system that wins 99% of the time, but the remaining 1% leads to utter bankruptcy, that system is garbage. The math of recovery is ruthless. Losing 50% of your capital requires a 100% return just to break even, a feat that can take a decade or more. If you avoid the deep hole, compound interest will do the heavy lifting for you. Therefore, a rational investor's #1 obsession should not be return on investment, but rather mitigating catastrophic risk. Excessive concentration is the most common poison for wealth, fueled by a combination of overconfidence and unbridled greed. David violated this principle by putting 100% of his net worth into a single luxury real estate development project, convinced his analysis was infallible. No analysis is infallible because you can't predict black swans, low-probability, high-impact events that alter the course of history. My personal rule has always been to limit any single position to a maximum of 25% of total equity. This figure isn't arbitrary. It allows for significant exposure to generate real wealth if you're right, but ensures that if you're wrong, the remaining 75% of your assets will still be there to bail you out. Smart diversification isn't a lack of conviction. It's the humble recognition that the future is a closed book for all of us. Liquidity isn't simply having money in the bank. It's the purest form of freedom and the ultimate tool of optionality. In periods of economic euphoria, cash is scorned because it doesn't generate returns and is eroded by inflation, leading many to invest every last penny to maximize efficiency. However, that maximum efficiency is a recipe for fragility. When the market collapses and credit freezes, cash becomes the scarcest and most coveted asset on the planet. Those with liquidity in a crisis not only survive, but also dictate market conditions. You can buy quality assets at previously unthinkable prices simply because the seller is forced to liquidate to avoid ruin. Keeping 20% of your portfolio in liquid assets is the price you pay for the right to be the predator rather than the prey. Cash flow is the lifeblood of your wealth, especially when market valuations plummet and panic grips the masses. There's a world of difference between being paper rich and being cash flow rich. The former is ethereal and dependent on the fickle moods of other investors, while the latter is tangible and provides a foundation of daily security. You should focus your wealth building on income-generating assets that don't require your physical effort or presence. Dividends from consumer staples companies, rents from well-located commercial real estate, and royalties from intellectual property are examples of flows that won't stop even if the stock market index drops by 30%. When your passive income exceeds your operating expenses, you become financially invincible as price fluctuations on the stock exchange screen become irrelevant to your actual survival and well-being. Intellectual arrogance is the catalyst that transforms a bad run into utter ruin, and it's the most common flaw among investors with high IQs. The fragile investor becomes enamored with their own theses and refuses to consider scenarios where their fundamental assumptions are wrong, leading them to use excessive leverage to amplify their perceived successes. The anti-fragile investor, on the other hand, practices reverse investing, constantly asking themselves what would have to happen for their plan to fail spectacularly. This paranoid optimist mindset allows them to build defenses in the right places before the crack appears. By assuming you're fallible, you force yourself to create safety margins that absorb your errors in judgment. The goal isn't to be right 100% of the time, but to structure your finances so that you win big when you're right and lose very little when you're wrong. Debt is the greatest amplifier of vulnerability because it introduces a timer into your financial life that you can't control. Leverage can make a good investment seem extraordinary in boom times, but it's a double-edged sword that can wipe out investors at the first sign of volatility. Debt robs you of patience and forces you to make decisions based on the need to pay, rather than market logic. A debt-free person can afford to wait a decade for their thesis to be fulfilled, while a leveraged person can be wiped out in a single day by irrational movements. At Berkshire Hathaway, our aversion to debt isn't outdated conservatism. It's a deliberate strategy to ensure that we are always the ones providing stability to the system, not the ones begging for it. Financial freedom begins the day you stop being a slave to other people's interests. Redundancy, often criticized by proponents of extreme efficiency, is actually the heart of a robust and anti-fragile system. In aerospace engineering, critical systems are duplicated or triplicated so that the failure of one part doesn't bring down the aircraft. Your financial life should operate under the same principle of safety. This means not depending on a single bank, a single currency, a single country, or a single source of income. Geographic and jurisdictional diversification protects you against political and regulatory risks that most people don't even consider until it's too late. Having a backup of your essential resources allows you to absorb systemic shocks that would destroy a more efficient but less prepared competitor. The cost of maintaining this redundancy is negligible compared to the value of survival in a mass financial extinction event. Controlling emotions, particularly fear and greed, is what ultimately separates generational wealth holders from momentary speculators. The market is a mechanism designed to transfer wealth from the impatient and emotional to the patient and rational. When you see others getting rich quickly with the latest speculative fad, your brain fires off envy signals that cloud your ability to think critically. This is the fragility trap, abandoning your principles of security to chase a euphoria that is about to collapse. The mental discipline required to stay the course when everyone else is losing their minds is the most profitable skill you can develop. Emotional antifragility involves cultivating a stoic indifference to short-term movements, knowing that your system is shielded from disasters and positioned to capture long-term value. Envy is undoubtedly the most absurd and destructive of the 7 deadly sins an investor can harbor, primarily because it's the only one that offers not a single ounce of momentary pleasure. While gluttony or lust provide fleeting satisfaction, envy only breeds a sense of lack and bitterness that clouds the rational judgment necessary for financial survival. In the world of investing, watching your neighbor get rich quickly from a speculative stock or a tech bubble is the ultimate test of your emotional antifragility. If you allow the success of others to dictate your strategy, you immediately become fragile, abandoning your margin of safety for an ego-driven gamble. True wealth isn't measured by comparing yourself to others, but by the strength of your own system and your ability to ignore the noise of the crowd while adhering to a decades-long capitalization plan. Delayed gratification is the superpower that allows compound interest to work its mathematical miracles uninterrupted. Most people are biologically programmed to seek immediate reward, consuming their capital on luxuries that depreciate the moment they leave the store, keeping them in a perpetual rat race. To be anti-fragile, you must develop the ability to see money not as something to spend, but as an army of soldiers working for you around the clock. Every dollar you save today and invest wisely is an employee who will generate more employees in the future. If you sacrifice frivolous consumption today, you are buying absolute freedom tomorrow. This approach requires iron discipline, but it is the only guaranteed way to build wealth that not only lasts your lifetime, but transcends generations to come. The concept of the circle of competence is fundamental to avoiding the fragility that stems from ignorance disguised as confidence. You don't need to know everything about every trendy industry or cryptocurrency to achieve financial success. What is vital is precisely knowing the boundaries of what you truly understand. An anti-fragile investor stays within their circle of competence, where they have an unfair advantage of knowledge and experience, and has the humility to say, "I don't know," to everything else. Most financial disasters occur when people cross that line, lured by the promise of easy profits in sectors they don't understand. By specializing in a few exceptional businesses and understanding their inner workings, you drastically reduce the likelihood of being caught off guard by structural changes. It's better to be an expert in 3 things than a novice in 100, because depth breeds security. The margin of safety is the bridge that connects investment theory to the harsh reality of an imperfect and volatile world. Benjamin Graham taught that we should never buy an asset for what we think it's worth, but rather for a fraction of that value, leaving room for error, bad luck, or unforeseen crises. This margin is what allows an investor to be anti-fragile. If the business performs slightly worse than expected, you're still safe. If it performs as expected, your gains are extraordinary. Fragility arises when you pay perfect prices expecting perfect execution in a world that is inherently messy. Never position yourself so that you need everything to go right to survive. Position yourself so that even if many things go wrong, your financial structure remains intact and ready to capitalize on the chaos. Personal and professional integrity is a component of anti-fragility that is rarely discussed in economics departments but is crucial in practice. An impeccable reputation built over decades is an asset that cannot be bought but can be lost in a single moment of ethical weakness. In times of systemic crisis, trust capital determines who receives opportunities and who is left to fend for themselves. Business partners, lenders, and clients will flock to those who have proven to be honest and reliable when times get tough. By acting with integrity, you eliminate the risk of litigation, scandals, and social ostracism that can destroy fortunes overnight. Ethics is not just a moral imperative, it is a long-term risk management strategy that safeguards your career and your wealth. Jurisdictional redundancy is an advanced tactic for those who understand that political risk is a historical constant, not a geographical exception. Entrusting your entire wealth to the laws, currency, and whims of a single government is a form of extreme fragility that many investors ignore out of convenience or misguided patriotism. Changes in tax laws, disguised expropriations through inflation, or civil unrest can evaporate wealth accumulated over a lifetime. An anti-fragile system distributes your assets across different legal frameworks and stable jurisdictions, ensuring that a disaster in one place doesn't mean total ruin. This geographical diversification acts as life insurance against government incompetence. By holding accounts, properties, or businesses in multiple countries, you give yourself the flexibility to move and protect your capital regardless of the political climate in your home country. Continuous learning is the only way to avoid obsolescence in an economic environment that is evolving at an unprecedented pace. Charlie Munger always said that if you aren't constantly unlearning your old ideas and replacing them with more accurate truths, you are doomed to fail. Intellectual antifragility requires you to be a voracious reader and a critical observer of reality, accumulating mental models from diverse disciplines such as physics, biology, and psychology. These models allow you to synthesize complex information and make superior decisions compared to those who only see the world through the narrow lens of finance. Your mind is your most productive asset. If you stop investing in it, your ability to generate and protect wealth will wither. Unquenchable curiosity is the antidote to stagnation and the primary tool for spotting opportunities where others only see problems or confusion. Opportunity cost is the ultimate filter you should apply to every decision you make, both in your financial and personal life. Every time you say yes to a mediocre investment, you're saying no to an extraordinary opportunity that could arise tomorrow. The fragile investor feels the need to always be active, constantly trading for fear of missing out, which increases their transaction costs and errors. The anti-fragile investor, on the other hand, has the patience of a hunter. They can spend years doing nothing, accumulating cash, and waiting for the perfect opportunity that offers minimal risk and massive reward. This strategic inactivity is often mistaken for laziness, but it's actually a high-level discipline. And only when the odds are overwhelmingly in your favor should you strike with full force and capitalize on the opportunity with total conviction. Physical and mental health is the foundation upon which all wealth is built, and neglecting it is an unforgivable form of biological fragility. It's useless to possess $1 billion if your body is so deteriorated that you can't enjoy a single day of freedom, or if your mind is so stressed that you can't make rational decisions. Investing in a balanced diet, regular exercise, and quality sleep offers a return on investment that surpasses any financial asset. A healthy body supports a clear mind, and a clear mind is what prevents the foolish mistakes that destroy fortunes. Longevity is a critical component of compound interest. The longer you live and remain lucid, the more time your money has to multiply exponentially. Take care of your biological temple with the same meticulousness you use to care for your investment portfolio. Simplicity is the ultimate sophistication in designing an anti-fragile financial system, even though the financial industry tries to convince you otherwise in order to charge you exorbitant fees. Complex structured products, opaque derivatives, and high-frequency trading strategies are often traps that hide catastrophic risks beneath a veneer of brilliant technicality. A simple system is easy to understand, easy to audit, and, most importantly, difficult to break. If your strategy requires a black box algorithm or constant expert oversight, you are vulnerable to system failure or a lack of transparency. A true wealth is built on basic principles applied obsessively, buying productive assets at good prices, avoiding debt, maintaining liquidity, and letting time do its work. Don't confuse complexity with effectiveness. In most cases, simplicity is the strongest shield. The precision fallacy is one of the most dangerous traps modern analysts fall into, believing that adding decimals to their financial projections grants them a greater understanding of reality. In a complex system like the global market, being approximately correct is infinitely better than being precisely wrong. Financial antifragility is based on accepting that economic forecasts are, for the most part, pseudoscientific fantasies that ignore the inherent randomness of human behavior. Instead of trying to predict the future with fragile mathematical models, the wise investor builds a structure capable of thriving under multiple possible scenarios, even those that seem improbable today. This preparation for the unexpected is what allows your wealth to survive events that wipe out those who blindly relied on a single optimistic projection. Humility in the face of uncertainty is the foundation of true long-term security. Survivorship bias is a cognitive error that distorts our perception of success, leading us to emulate the strategies of those who won by sheer luck while ignoring the graveyard of those who did the same and failed. When you hear stories of investors who became millionaires using extreme leverage, you're only seeing the survivors of a financial game of Russian roulette. You don't see the thousands whose remains were left behind. An anti-fragile approach requires studying failures more closely than successes, identifying which behaviors inevitably lead to ruin, regardless of an individual's talent. If you eliminate from your life the practices that have historically caused collapses, such as excessive debt or a lack of ethics, success becomes an almost inevitable byproduct of patience. Don't strive to be a genius. Strive, above all, not to be persistently stupid. Optionality is the mathematical property that defines antifragility. It is the right, but not the obligation, to take an action that has a limited cost and a potentially infinite benefit. In your financial life, optionality is purchased through liquidity, diverse education, and a network of contacts based on integrity. When you possess options, you don't need perfect foresight of the future, because the very chaos will work in your favor by presenting opportunities that others cannot seize due to a lack of resources or mental clarity. Fragility is being forced to follow a single, narrow path. Anti-fragility is having multiple doors open when the environment changes abruptly. Design your life to maximize these positive options and minimize the negative ones, ensuring that the random events of the world propel you upward rather than dragging you to the bottom of the abyss. The concept of skin in the game, developed in depth by Nassim Taleb, is an ethical and practical filter you should apply to every piece of financial advice you receive. A system is inherently fragile if decision-makers don't suffer the consequences of their mistakes, transferring the risk to third parties while they collect their fees. Never entrust your wealth to someone who doesn't risk their own capital alongside yours, or who is protected by a golden parachute while you face the void. Anti-fragility requires a complete alignment of incentives. You must be the architect and ultimately responsible for your destiny. By assuming full responsibility, you develop a mental acuity that cannot be bought as the potential pain of loss forces you to maintain a vigilance and rationality that external advisors simply do not possess. Decentralizing your information sources is vital to avoid groupthink, a form of mental fragility that causes the masses to rush headlong toward the precipice during financial bubbles. If you consume only the same news, blogs, and analyses as everyone else in the market, you're doomed to the same mediocre results and panic at the same times. To be anti-fragile, you must seek out dissenting opinions and study disciplines unrelated to finance, such as military history or evolutionary biology, to find patterns of human behavior that repeat themselves century after century. This diversity of thought gives you a competitive edge, allowing you to remain calm when consensus breaks down and collective hysteria takes over. Intellectual independence isn't just a character trait, it's an essential tool for economic survival in the information age. Anti-fragility in employment or career advancement is just as critical as it is in an investment portfolio, especially in a world where artificial intelligence and automation are redefining the value of human labor. Being an extreme specialist in a single tool or process makes you fragile. If that technology disappears, you disappear with it. The anti-fragile strategy is to become a generalist with specializations, accumulating transferable skills such as communication, complex problem-solving, and an understanding of human psychology. These competencies are universal and become more valuable as the world grows more chaotic. By diversifying your human capital and maintaining a lifelong learning mindset, you ensure that any changes in the job market not only don't destroy you, but actually provide new and better opportunities to lead and generate economic value. The Lindy effect is a principle stating that for non-perishable things like ideas, books, or business models, their future lifespan is proportional to their current age. This means that a business that has survived 100 years, like a beverage company or a cement manufacturer, is much more likely to survive another 100 than a newly launched tech startup. To build anti-fragile wealth, you must tip the scales toward what has proven resilient to the test of time and past crises. Investing in the new and exciting is often an invitation to fragility. Investing in the old and tried is a strategy for resilience. Let others take the risk of novelty while you focus on assets that have weathered wars, depressions, and technological revolutions, maintaining their intrinsic value and ability to generate income. Emotional resilience is the ability to maintain inner equanimity when the market value of your assets falls by 50% or more, an event that will occur several times throughout an investing lifetime. Psychological fragility is what leads investors to sell at the lowest point of the cycle, transforming a temporary paper loss into permanent and definitive ruin. To cultivate this resilience, you must practice premeditatio malorum, premeditation of misfortunes, visualizing the worst possible scenarios and accepting them before they happen. If you have already mentally accepted the possibility of a major downturn and prepared your life for it with cash and solid assets, fear will lose its power over you. This inner strength is what allows you to act calmly while others give in to panic, buying when pessimism is at its peak and the opportunity is greatest. Cognitive biases are like glitches in our brain's code, inherited from our ancestors who needed to react quickly to predators on the savannah, but which are disastrous in the abstract environment of modern finance. Confirmation bias, loss aversion, and the sunk cost fallacy are drivers of fragility that compel us to cling to bad decisions out of ego or fear of pain. An anti-fragile system includes conscious protocols to identify and mitigate these biases, such as having a devil's advocate or a system of strict rules that override our momentary emotions. By recognizing that you are an imperfect thinking machine, you can design checklists and decision-making processes that protect your capital from your own destructive instincts. Rationality is not a natural gift, but a discipline that must be practiced and reinforced daily through study and constant self-criticism. The cost structure of your personal life is the factor that determines your financial breaking point and, therefore, your level of vulnerability to adversity. A lifestyle with high fixed costs, massive mortgages, financed luxury cars, and prestige expenses forces you to take unnecessary risks to maintain cash flow, leaving you with no room to maneuver in the event of a loss of income. Conversely, a modest and flexible lifestyle is an immense source of anti-fragility. It gives you the freedom to wait, change course, or invest aggressively when the market offers opportunities. Don't let your expenses grow at the same rate as your income. Keep the gap as wide as possible. True wealth isn't what others see, but the peace of mind that comes from knowing you can survive for years without outside income, keeping your integrity and long-term vision intact. The concept of an economic moat is the unit of measurement for anti-fragility in a company and, by extension, in your investment portfolio. A fragile business is one that competes solely on price, on leaving it at the mercy of any rival willing to accept lower margins. An anti-fragile business is one that possesses a structural competitive advantage, whether it be a powerful brand, a network effect, or a cost advantage in production. As an investor, your task is to identify these moats before the market fully values them and preserve them for decades. Fragility stems from investing in companies that lack defenses against the constant onslaught of competitive capitalism. By focusing on assets protected by deep moats, you are buying a cash flow that has a high probability of surviving wars, inflation, and technological change, providing you with the security needed to remain calm while others watch their empires erode. Patience is not simply the ability to wait, but the skill of maintaining a positive and rational disposition while you wait for compound interest to do its invisible work. In a world obsessed with instant gratification and quarterly results, patience is the greatest anomaly and, therefore, the greatest competitive advantage. An anti-fragile investor understands that time is the best friend of a great business and the worst enemy of a mediocre one. Most financial mistakes occur because of the desire to accelerate a process that is inherently slow. Solid wealth requires years of quiet fermentation. If you unnecessarily interrupt your compounding process because you get bored or feel pressured to do something, you are destroying the architecture of your future. Learning to sit on your hands and do nothing is, ironically, the most difficult and profitable activity you will ever undertake. The network effect is one of the most powerful mental models for detecting anti-fragility in the digital age, as it describes systems that become exponentially more valuable with each new user who joins. A fragile system loses value if one part disconnects. A system with a network effect becomes more resilient and dominant as the number of connections grows. Identifying companies that possess this dynamic allows you to invest in structures that have their own momentum toward success. However, you shouldn't confuse viral growth with sustainable profitability. The real pitfall appears when the cost of exiting for the user becomes prohibitive due to the utility they receive from the ecosystem. By incorporating these assets into your portfolio, you are aligning yourself with the power law, where benefits are not distributed linearly, but are massively concentrated in the market leaders who manage to survive. The autopsy of your own and others' mistakes is the exercise in humility that shields your judgment from repeating financial tragedies. An anti-fragile investor doesn't sweep their failures under the rug of ego, but rather dissects them with the coldness of a pathologist to extract the lessons that will prevent future ruin. You must keep a written record of your investment decisions, documenting the original reasoning so you can compare it with the actual results months or years later. This allows you to identify whether your successes were due to skill or luck, and whether your failures were due to a procedural error or a low-probability event impossible to foresee. Without this process of honest feedback, you are doomed to be a victim of your own biases and to remain in a state of intellectual fragility where learning is nil and risk is maximal. Reverse inversion is the mental process of approaching a problem from the end, asking yourself not how to win, but what you would have to do to lose everything, and then actively avoiding those behaviors. Munger always said, "Tell me where I'm going to die, so I never go there." If you want a successful financial life, identify what causes ruin: gambling, alcohol, debt, bad company, and overconfidence. By radically eliminating these factors from your life, success becomes the natural byproduct of your prudence. Fragility is often the result of pursuing positive optimization without first eliminating extreme negative exposure. By inverting the problem, you realize that it's much easier to avoid foolishness than to pursue genius. True security isn't built by adding layers of complexity, but by subtracting sources of catastrophic risk and avoidable mistakes. The theory of complex adaptive systems teaches us that the economy is not a predictable machine, but a living organism that changes in response to our own actions and expectations. This understanding is the basis of anti-fragility. If you treat the market like a watch you can repair, you will break down when the system behaves erratically. If you treat it like a jungle where you must survive, you will develop the instincts necessary to protect yourself. Fragility arises from the belief that equilibrium is the norm, when in reality, imbalance and volatility are the norm. Your financial strategy must be flexible enough to adapt to new paradigms, but robust enough not to be swept away by them. By accepting that you don't control the system, you regain control over your own response to it, which is the only form of true sovereignty in a chaotic environment. The Pareto principle, or the 80-20 rule, is a constant reminder that the majority of your returns will come from a minority of your stocks and investments. In an anti-fragile portfolio, 2 or 3 positions are likely to generate the vast majority of long-term wealth, while the rest merely provide stability or mediocre returns. The key is having the discipline not to sell your winners too soon simply to secure a small profit. You must allow your exceptional investments to continue growing while quickly cutting losses on those that have proven fragile or whose moat has evaporated. Anti-fragility is about having unlimited exposure to success, the upside, and full protection against absolute failure, the downside. By concentrating your resources on what works and protecting yourself against what doesn't, you maximize the efficiency of your capital over time. Education in mental models from diverse disciplines gives you an X-ray vision of reality, allowing you to see the invisible threads that move markets and human behavior. An investor who only knows accounting is like a man with a hammer who sees every problem as a nail. He is inherently fragile when faced with problems that require knowledge of psychology, biology, or engineering. To be truly anti-fragile, you must build a lattice of mental models in your head and hang your experience upon them. This allows you to make connections that others ignore and foresee second- and third-order consequences that the masses failed to grasp. Wisdom is not the accumulation of data, but the ability to synthesize universal principles to make sound decisions under conditions of uncertainty. Your mind should be a diverse ecosystem of ideas that constantly challenge and reinforce one another. The sunk cost is one of the most common psychological traps that keeps people tied to situations, businesses, or investments that no longer make sense. Fragility arises when you allow the time or money you've already spent to dictate your future decisions, instead of evaluating the situation based solely on current prospects and opportunity cost. An anti-fragile investor has the ability to admit, "I was wrong, circumstances have changed," and liquidate a losing position without feeling their ego has been wounded. The past is unchangeable, and the money spent won't come back. The only thing that matters is the best possible allocation of your capital from this moment forward. By freeing yourself from the chains of sunk cost, you regain the agility needed to move toward more productive and secure assets, protecting your wealth from the slow but sure erosion caused by pride. We've reached the end of this treatise with the most important lesson of all. Financial anti-fragility is, ultimately, a tool for moral freedom and peace of mind, not an end in itself. It's pointless to have followed these 40 paragraphs of discipline if you end up becoming a slave to your own numbers or a miserable person unable to enjoy the security you've built. True wealth is the ability to live life on your own terms, acting with integrity, and contributing to the well-being of those around you without the constant fear of lack. By building a system that thrives on chaos, you've eliminated anxiety about the future and reclaimed your time, the only truly non-renewable resource. Now, with this impregnable mindset, you're free to pursue a purpose beyond money, knowing that your financial strength is a foundation that nothing can easily tear down.